Hello, welcome once again to Tabs Forex Academy, where everything is all about financial markets. Don't forget to like, subscribe to this YouTube channel, Tabs FX Academy, and hit that bell icon such that you don't miss out on any new video that is uploaded. And finally, don't forget to join our community of Forex traders that is on Telegram, Tabs FX Academy, where everything is shared right from the books in PDF format, the audios, the videos, the tips, and many more. This is our second lesson in the series, Introduction to Financial Markets. And to be specific, that is terminologies or terms used in the financial market. And in this lesson today, we're going to be looking at three things. Number one, what an exchange rate is. What does the term currency quote or pair mean? The terms bid and ask spread. What do these mean? So, let's start. In the previous lesson, we talked about the foreign exchange market. Just a reminder here is that a foreign exchange market simply refers to the trading of one currency over another. In other words, in case you're having euros and you want to get dollars, the exchange between those two is what we call the foreign exchange. And we see that it is one of the busiest, one of the most active financial markets in the whole world. In other words, when you combine stocks, bonds, equities all together, foreign exchange market is way much bigger than those. In other words, statistics show that this market is worth between $1 to $2 per day. In other words, that amount of money changes hands per day. It is also known the forex market, the FX market, the currency market, all mean the same thing. And one most important thing as why we're interested in this market here is because the exchange rates, for example, give us an idea of the economy of a given country. In other words, when you look at the currency quotes, as we're going to be seeing later on, if the value of one currency against the other is increasing, it means that the economy of that country is going down. If you've done economics at A level, you know this. So in other words, foreign exchange rates give us an idea of how the economy of a given country is doing. And this may lead to investors coming into that country or going away from that country. Now, let's look at each of the terms in great details. Exchange rates. What is an exchange rate? For example, we've talked about having two currencies, that is the euro and the dollars. If you're exchanging these two, that is what we call forex exchange. If you attach specific values to that exchange, then we talk about what we call an exchange rate. In short, we define an exchange rate as the value of one currency expressed in terms of the other. For example, if you're buying 1 euro, you may need 1.3200 US dollars, depending on the current rate. So that's what I mean by forex exchange rates. I'm going to be talking about this more when I'm talking about the currency quote. So, currency pairs, like we said, that the currency of each country is always written using 3 letters. And in this case, we're talking about the currency pairs, all the quotes. And we always write them using, separating them using a forward slash. The first one is always called the base currency. I'll explain that more in later on. And the second one is always called the quote currency. Now, sometimes there is a forward slash separating them, and sometimes that is not there. So the meaning remains the same. The first one is the base currency. The second one is the quote currency. So the exchange rate of two countries is quoted in a pair, such as the Euro USD or the USD JPY, that is Japanese yen. The reason for this is because in any foreign exchange transaction, you are simultaneously buying one currency and selling the other. Like we talked about this earlier on. The buying and selling is always simultaneous. And like we said that in case the value of the quote currency, for example, in this case the Euro USD, the quote currency the USD, in case the USD goes up, it means that it is losing value against the euro. In case it is going down, it is gaining value against the euro. So that is what it means. Now in this red part here, euro USD equaling to 1.32105 means that 1 euro is equivalent to 1.32105 US dollars. That is what that means. That we've talked about that under the exchange rates. So if you continue with this, we have an example here. I'll be talking about the bid and ask later on. But we're having examples of some of the currency pairs. We need to note this, that we have 8 most commonly traded currencies, and we call those ones the major currencies. In other words, they're the currencies of the major economies. We have the Euro USD, the British Pound, the Japanese Yen, the Swiss francs, the Canadian dollars, Australian dollars, and then the New Zealand dollars. Other economies are coming in, like the South African rand, among others. So we have the major ones, and then we have what we call the exotic ones. I will not be going into the details of all of those, but what you know is that the major ones are the most commonly traded currencies, and they're basically for the major economies like the US, the UK, Japan, and so on. And then we have what we call the exotic ones. In other words, a currency of the major economy paired with a currency with an upcoming economy. That's what we call an exotic pair. You can do some more research about this. Now, the trading of foreign currencies clearly involves selling one currency and buying another. The two currencies involved are what we call a currency pair. For example, in this case, we are having what we call the USD and then the GBP, that is the Great British Pound. According to what we're seeing here, what is on the left-hand side is what called the base currency, and what is on the right-hand side is what called the counter or the quote currency. Now, a base currency, what is this? The first currency on the left-hand side, whether before the forward slash or before the next one, is what called the base currency. Now, by default, this one is always given a value of 1. It is always equal to 1. And then the counter currency or the quote currency, which is always on the right-hand side of the pair, is always having any other value, whether bigger than 1 or less than 1 or equal to 1, as we shall be seeing later on. For example, in this case here, we have on the left-hand side we have $1, and on the right-hand side we have 0.75 pounds. What does this mean? It means that $1 is equivalent to or is worth 0.75 pounds. That is what we call an exchange rate. Now, when the exchange rate is being quoted, the name of each currency is always abbreviated for 3 letters, and we talked about this earlier on, so we need to be knowing that. And some of the most commonly traded currencies, we have what we call the US dollar, the Japanese yen, we have the euro, we have the USD, we have the Swiss francs, that is CHF, we have the pound, yeah, like that, and other currencies as we shall be seeing later on. Now, assuming that we have a pair which is quoted as this, the US dollar against the pound, when quoting the base currency, like I've said, that its value is always equal to a 1, even though it is not mentioned. Even though it is not mentioned, it is always equal to a 1. Now, in this case, we're having this value here. So if I'm having this here, USD GBP is equal to 11.1164 and 1 against 1.1166. What does that statement there mean? Of course, if it was just one value, 1.1164, it would simply mean that $1 is equivalent to 1.1164 pounds. But now we're having two values. What does this mean? Now, what this means is that we're having what we call the bid price and then the ask price. And this is always set by the market maker. In other words, the major international banks, which set these values here, depending on the demand and supply of each of those currencies there. Of course, you know from economics that if the supply is low and yet the demand is high, then the prices go high. If there's too much supply of something, normally the prices tend to go down. Now, in this case, These values here are set by the market makers, the major international banks, and they quote the figures at which they give the price that the retail traders like us can buy the currency, and then they also state the figure at which they are willing to buy that same currency from you. They sell to you and they buy from you as well. Just like what the forex bureaus do. Now, in this case, we're having that $1 is going to be bought by you, the retail client, the retail trader, at a higher price. That higher price is not called the higher price. In this case, it is 1.1166 pounds. And then that market maker, the bank, the brokers, they're going to buy that same currency, that is the US dollar, from you at a price of 1.1164 US dollars. In other words, you always buy high and you always sell low to the market makers. Now, in this example here, we're having that a client wants to buy 100,000 US dollars. How much is that person going to be paying? Now, normally, like we've said, that the client is always going to pay a higher price. In this case, which is 1.116, this is a mistake, supposed to be 1.116. So this means that when you multiply the 100,000 by this figure here, the person will be paying a higher figure, which is 111,660 pounds for just $100. Now, if this person is willing to sell back that price there, the market maker or the bank or the forex trader, the forex bureau, is going to be paying that person a lesser amount, which is 111,640 pounds. Now, it means this, that the difference between the two, the bid and the ask, will simply give us what we call a spread. Now, if there's too much money that is exchanging hands, too much money, in other words, if there's too much liquidity in the market, then that spread is always narrowed down. So you should be having a narrow spread, and this is normally happening in certain time intervals, what we call the sessions. I'll be talking about this later on. And the spread is always big or wide during illiquidity, in other words, less liquidity in the market. Few traders are making transactions. That's when the spread is too big, and it is not recommended to buy during this. However, it doesn't change anything, because if the market is going in your direction, then you'll always make a profit. Whether it is going high or whether it is going low, you'll always make a profit. In short, when we talk about the bid is the price at which the dealer or the bank is willing to buy another currency from you, the trader. And this is always the lower currency. And then the ask price is what you call the price of the currency at which the dealer or the bank is willing to sell to you. So as the bank is selling, you are buying. And I'm saying that you always buy at a higher price and you sell at a lower price in that particular quote. However, like I said at the beginning, that these values are always increasing if the market is going up, and you always make a profit. I'll be talking about this, explaining all these terms that they use. Otherwise, at the moment, I hope that you've understood what the term exchange rate is, a currency pair, the bid price, the ask price, and then the spread. Let's meet again in the next lesson. Don't forget to subscribe, to like, and then to hit that bell button. Have a great day.